Welcome to another Mr. James accounting tutorial. This time we are looking at accounting Unit 1 of CAPE, and I'll be doing the entire series of past paper from 2013 right down to 2019, and there was no paper in 2020. Part E. The regulatory framework requires companies to provide users with relevant and reliable financial statements that record the economic substance of transactions. Using appropriate examples, explain the following accounting terms: substance over form, relevance, and reliability. We start with substance over form. Substance refers to the practical aspects of the transaction, and form refers to the legal aspect. The practical takes precedence over the legal aspect of a transaction when recorded. An example: the purchase of a non-current asset on hire purchase. The legal form of the transaction says the assets belong to the seller until the last installment is paid. Therefore, it should not be recorded in the business books at the time of the initial agreement. However, since the business has practical use of the asset is no different from others it owns, the practical view is preferred and it is recorded at the date of the hire purchase agreement. Relevance. Information must be presented on a timely basis and be useful in making decisions. It should have feedback value, which consists of predictive value and confirmatory value so as to influence decision making. An example: an investor takes a decision to invest in a company's shares on the basis of this year's financial statements. He used the predictive value. Next year's financial statement will confirm his decision whether it was a good decision. Reliability. This refers to the trustworthiness of the information, whether it can be depended upon to make accurate decisions. It stems from representational faithfulness, neutrality, free from bias, and verifiability. An example: financial statements which have been audited by independent external auditors who has expressed an opinion on them are considered reliable. Welcome back, and let me take the opportunity to say those who have not yet subscribed for the channel, you can take the opportunity to do so now. Module 2 will be coming up again next week. Part B lists the 5 elements of a full set of financial statement as required by IFRS for SMEs. That's the first part of Part B. The 5 elements of a full set of financial statements. First, we have the statement of comprehensive income. Next, we have the statement of financial position. The statement of comprehensive income is also known as an income statement. Statement of financial position as a balance sheet. Statement of changes in equity. And statement of cash flows, also known as the cash flow statement. And finally, the notes to the financial statements. These all must be present in order for you to have a full set of financial statements as required by IFRS for SMEs. Part 2 states: state 4 reasons why financial statements do not provide users with all the information they need. Okay, the focus here is on all the information they need. Okay, so 4 reasons why financial statements do not provide users with all the information they need. First reason: the accounting standards require only items stated in the accounting standards to be reported. Therefore, items not stated within may be excluded. And of course, the user may need some of those items that are excluded. Two, it is not cost effective to include all the needs of all its users. Okay, if you were to include everybody's need and satisfy everybody, what's going to happen is your cost of providing the information is going to go up. It may be impossible in a single set of financial statements to meet all needs of all users. Okay, so you are constrained to one set of financial statements that is supposed to satisfy a number of users. Therefore, some people would remain with their needs unmet. And four, financial statement uses the historical costs. Users may need more updated values. And I've added on a fifth one for you. Financial statements uses estimates which are subjective to its preparers. These cannot meet the needs of other people or other users. All right, let me explain what we mean by subjective to preparers. The accountants who prepare them use a certain amount of subjectiveness when they estimate things. Any other accountant or person estimating it might come to a different value. So you could have, when you're dealing with estimates, what you can have is any number of estimates on a particular item. And part three, give four reasons why the role of the external auditor is important to users of financial statements. Four reasons why the work of the external auditor is important. One, they express an opinion on the fair presentation of financial statements. Users normally rely on their opinion. Two, reports to shareholders on the performance of management. Okay, they are the watchdog for management and they report to the shareholders on the performance of management. Three, they review internal control for as far as they affect the accuracy of the financial statement. Okay, so we need someone to look out for the internal control, and the auditor, external auditor, is the one who performs audits upon it, and those things can affect the accuracy of the financial statement. Four, independent of the company, which has implications about neutrality and bias in the financial statements. Okay, so they are independent of the company. That means they don't work for the company. They report to the shareholders. They don't work for the shareholders either. That means they are independent. And if you want to get information or financial statements that are free from bias and neutrality to users, you can get that from the audited financial statement. Welcome back again. If if you haven't yet subscribed, this is a good time for you to do so, to take the opportunity. If you like the videos that you see, give them the thumbs up. And if you find them helpful and you wish to see much more videos like these, leave a comment in the box below and let me know what you would like to see. Old Bailey Limited is keen to ensure the accuracy of information contained in its accounting records and the safe custody of assets such as inventory and cash. State four appropriate controls that may be used in each of the following cases. Accounts receivable. and cash at bank. First, we look at four controls for accounts receivable. First, you must have approval of credit by the supervisor's signature. Okay, you must have someone in control of your credit department, and they must give approval for the credit. Usually, the approval is by their signature. Two, documentation. You should pre-number the invoices, ensure all credit sales are accounted for. Okay, a number on each one would make you look out for each invoice that you make your credit sales with, and you can easily account for them. If there's one missing, you will know, especially if the numbers go in sequential order. Three, we have segregation of duties. Persons who handle receipts from the debtors should not issue credit notes. Okay, so if you are handling the cash, you should not be documenting things like credit note or even the invoices. You should not be recording them. The idea here is to separate the recording function from the custodial function. Those who are handling the accounts and the cash should not also be recording or making out credit notes and invoices. Timely reconciliation of accounts receivable ledger and sales ledger control account. So you must do it on time. The account receivable ledger tells you how much your debtors owe you in their individual accounts, and these must be tied in with the sales ledger control, which is the total of all the accounts receivable in the accounts receivable ledger or the sales ledger. Four controls for cash at bank. One, again, we have segregation of duties of receiving, recording, and payment of cash. The idea is the same, that you should separate custody and recording. Two, use pre-numbered checks for transaction involving cash at bank. Pre-numbered checks will allow you to chase every check that was drawn on your bank account. Do regular bank consider do regular bank reconciliations, and four, you store such documents for as blank checks and return checks in fireproof cabinets and restrict access to these. Part D, you are the assistant to the Chief of Finance Officer of Blooms and Shrubs Garden Center, which is at the end of its first year of operation. The company has issued 50,000 ordinary shares of 50 cents each and 20,000 7% preference shares of $1 each. Its profits after taxation for the year to 30th April 2016 were 84,000. The board of directors has decided to pay preference dividend and transfer 16,000 to the general reserve. Prepare the journal entries to record these events. Okay, so what we have here is journal entries again. Now, if you look at all the past papers we have done so far from 2013, this is 2016, and we have done 2017 already, and 2019. Each one of them has journal entries on it for different types of items like these. Um, so, okay, so you would do well to go over those videos and prepare yourself for some of them coming in your exam. Okay, so the issue of the ordinary shares, journal entries. Right, the company issued 50,000 ordinary shares, 50 cents each, and 20,000 7% preference shares of $1. So the ordinary shares first. Cash would be 25,000. 50,000 by 50 cents is $25,000, and it's all ordinary share capital. And there was no premium. So the narrative would be issue of 50,000 ordinary shares at 50 cents each. Okay, the issue of the preference shares. Again, it's cash, so we get 20,000, $1 each would give us 20,000, 7% preference shares, 20,000. So we issue 20,000 preference shares of $1 each uh, as the narrative. The distribution of the preference dividends. Now notice this one here, you are distributing it. They didn't say the declaration of the dividend would have taken place sometime before the distribution, and the amount would have been paid in placed in a liability account. Therefore, we have to debit dividend payable of 1,400. That is 7% of 20,000, and the cash would be credited with 14,000. Okay, notice again here is dividend payable. Okay, it's not just dividend. If you do put dividend alone, it would mean you are now declaring it. Distribution of preferred dividend as a narrative. Transfer of profits to general reserve. Um, first we have to take it out of retained earnings, 16,000, and then we have to put it in the general reserve, 16,000, transfer to general reserve. Okay, so the 16,000 is given to us here. Okay, that is the last of the journal entries. And again, if you have not yet subscribed, I'm inviting you to do so now. If you have benefited from the use of these videos, and please leave your comments in the box underneath. I'm getting very few comments, and I don't know if these videos are helpful to you or not if you aren't commenting on them. And okay, so please let us see some comments, and see you in the next video.